Hey everyone, we're going to cover XDTE, an ETF that seeks to provide weekly income from a zero-day covered call strategy using the S&P 500 index as the reference index. Hello, my name is Skip Kapoor and my channel is Passive Income from Equities. And I will be doing a thorough review of this ETF. As always, all the information that I provide is for information purposes only. Always do your own due diligence before making any purchasing decisions. Let's cover some basic information on XDTE. Its name, the name of the ETF is S&P 500 Zero DTE Covered Call Strategy, and the DTE stands for days till expiry, so 0 days till expiry. So it's the same day covered call strategy. The company that provides it is Roundhill. They've been around for about 5 to 6 years. The objective, which I got from the prospectus, is the primary objective is to provide current income. The secondary objective is to provide capital appreciation. For those of us who are living off of our Nasdaq, people like me, this is exactly the objective that I'm looking for in my ETF. So far, so good. The strategy that XDTE, the managers of XDTE use to fulfill the objective, three major points. One is they generate income each morning by selling out of the money 0 day to expiry calls on the S&P 500 index. These are cash settled at the end of the day, and the call expires at the end of the day. Now, the one thing to keep in mind, and most people don't pay attention to this much detail, but it is kind of relevant, is overnight you have exposure to the index. So if the S&P 500 index moves up overnight, the next morning you're getting to sell calls at the higher price. So that's a net very positive thing. The second thing to know about the strategy is that these guys, unlike SPY and some other ETFs that I own, don't actually own the S&P 500 either via individual stocks or through an ETF like IVV or VOO. They own it synthetically by purchasing deep in the money call options. I'll cover how they do it and what that means later. And the last thing about the strategy is that they provide weekly distributions. To the best of my knowledge, they are the first and so far maybe the only covered call ETF that I'm aware of that provides weekly distributions. So let's continue with some more basic information regarding the structure and some key personnel, which I tend to pay attention to. The company that provides the fund, as I mentioned previously, is called Roundhill. They've been around since 2018. The portfolio managers, and as best as I can make out from the portfolio, these are employees of Roundhill, which I consider a positive. And you can see the names. I've looked for interviews with them just to get a sense for their capabilities and their approach towards execution. Haven't been able to find much. The sub-advisor that they use is called Exchange Traded Concepts. Usually sub-advisors are used to actually execute to the strategy, like NEOS does it, for example, by providing options experience to other companies. In this case, what Exchange Traded Concepts is doing, as best as I can make out by looking at their website, is that they're simply providing the white label wrapper for the ETF. In other words, they're doing all the regulatory documentation, reporting, etc. for Roundhill. So it's almost reverse. That is, Roundhill is providing the technical competence and Exchange Traded Concepts is providing the administrative capabilities. So now let's start getting into the meat of the ETF. So as I mentioned previously, XDTE holds the S&P 500 synthetically. And what does that mean? They do it by purchasing calls on the index deep in the money for the long term. So the fund came out in March of 2024, and these are the holdings as they are right now. It's close to just under 100%. So they own a set of calls at 5,200 maturing next June. Then they own a set of calls at 4,200 maturing next March. And just for reference, the SPX closed on Friday, the 6th of September, at 5,400. So 5,408 to be specific. So what that means is these calls are in the money, and my sense is that the index has increased since March. Therefore, we're in the money. So, and whatever cash is left over is invested in FGXXX, whatever this first American government obligations fund is. So that's basically the holdings of XDTE. Normally, in covered call ETFs, when you look at the holdings page, you will actually see the calls that the ETF has sold in order to generate option income. And you saw on the previous page, there was no such thing. The only holdings were the calls that the fund had actually bought in order to have ownership of the S&P 500 synthetically. So what about the actual covered calls sold to generate income? So what happens is, because they are 0 day to expiry calls, they will never show up on the holdings page, because at the end of the day, those calls have expired. So what I did was I went to Friday, November 6th, which is the last trading day that was completed. I'm doing this on Sunday, September the 8th. And I wanted to see how they're going about it, and especially if they're selling calls out of the money, which is essential, because I will not buy any covered call ETF that sells, at the money calls, because that's a surefire way to have net asset value degradation. So here's what I found when I went to the website and I looked at that day's trade. First, they had sold a call at about 8:30 in the morning on last Friday for the index at 55.50. For reference, I went and found out what the price of the S&P index was at 8:30, and it was at 5514.54, as I'm showing here. So the difference was about 36 points, which is 65 basis points of difference. So the call that was sold was out of the money. Good. I like it. 65 basis points for about 7-8 hours of coverage, actually less, is even better. So far so good. And just as a reference, it doesn't really matter because it was just one day. The index had a down day, as you may recall, and it actually closed at about 54.08. So these guys ended up pocketing the option premium. Okay. Some other information related to the fund. Their assets have grown since March to about 100 million plus. So they're probably growing at a rate of about 10 million a month, which is pretty darn good. Once they get to about maybe a billion, give or take, I would say liquidity will not be too much of a problem. So the inception was March 7th. The yield, they've given 25 weeks of distribution so far. If you annualize it, it's around 26%. Astonishing, yes. Perhaps too high, possibly, but that's what it is. And the expense ratio is high, and I'm marking it in red. It's about 95 basis points at the absolute high end of what I consider acceptable. Let's take a look at performance to date. I'm going to use two different sources and two different types of comparisons. One is dividend channel, which allows you to compare two ETFs. And then on the subsequent page after this one, I'll use Vanguard's ETF comparison tool that allows up to 5. And the bottom line is that XDT is going to come out pretty good so far. It's only 6 months of data, not by any stretch of the imagination a long enough record, but hey, there's no harm in starting off strong. So what dividend channel is showing, what I did was I compared XDTE to the S&P 500 index. So my entire portfolio I benchmarked to the S&P 500 index always. And what it's showing is that on an annualized basis, remember there's only 6 months worth of data, it's outperforming the S&P index by about 252 basis points, which is quite remarkable for a covered call ETF, because normally I expect a degradation of performance in the range of about 100 to 150 basis points. So far, it's really performing quite well. And just to state the obvious, there's not enough data, it's only 6 months, but early indications are positive. Okay. Now let's compare it to 4 other products. And I've used Vanguard's ETF comparison tool. And I own all of these products. So SPY-T is a strategy from Defiance managed by Jay Pestricelli, a guy I really respect. That's a covered call spread strategy. SPY-I is from NEOS, run by a guy called Garrett Paolela, I think. Again, another company and person I respect. That's a straight covered call out of the money strategy on a monthly basis. They sometimes sell weekly out of the money, but their distributions are monthly. QDPL, yet another fantastic ETF from Pacer that gives you raw coverage of the S&P 500 up to 88%, and they take the 12% of the assets and buy dividend futures. A very good strategy. Bali is from BlackRock, and it's actively managed, but it's pretty close to the S&P 500, and in their prospectus, they're actually using the S&P 500 as their benchmark. And it's one that I've only recently started gaining a position into. So those are the 5 I chose, and what Vanguard does is it gives you S&P 500 automatically. So let's take a look at some of the obvious conclusions. So that this is total return. So this is both net asset value movement plus any distributions, both. So the S&P 500 during this period from March 6th, according to the site, the S&P 500 moved up 7.39, XDTE by 802, so it's fairly meaningful. And every other one was lower than the S&P 500. SPY-T, SPY-I, QDPL, and Bali were all lower, but again, not significantly. And that is what I expected even from XDTE, because the performance from SPY-T, SPY-I, QDPL, and Bali are what I expect. I expect higher income and lower total return. So XDTE is doing something, frankly, terribly out of the ordinary. Again, short duration, but I got to give kudos where they are due. So one of the things very much top of mind for me when I look at enhanced income investments, especially covered call based strategies, is that the distributions must be non-destructive return of capital if they're using return of capital. So if it's non-destructive return of capital, what that means is that you get the money showing up in your brokerage account as cash, but you're not really declaring it on your taxes for that year. It lowers the cost basis cent for cent. So when you sell it later, you end up paying more in capital gains. But for people like me who for the most part are just wanting to live off of the income, the non-destructive portion, if the return of capital is non-destructive, that's a tremendously beneficial thing, both from a spending point of view and from a tax benefit point of view. So the way you can find out how much of the distribution is return of capital is by looking for a 19A1 statement. So the way Roundhill does it, they have one for every month. I didn't want to show you the ones for every month, but you can see by looking at it that 100% of the distribution, the last one done in August, was return of capital. And I went through every month. I record it and track it every month, has been similar. So in my book, 100% of what I have received from XDTE this year is return of capital. Now, to decide whether it's non-destructive, you have to look at net asset value, because all the 19A1 is telling you is how much of it the fund is marking as return of capital. And the reason they do it is because of two things. One, the IRS allows you to do it if you're using the index, and because it's cash settled, there's give and take. So that's kind of my understanding of how this ends up being return of capital. So we'll talk about the net asset value degradation in just a little bit. The bottom line is I'm quite convinced that there is no net asset value degradation. So in other words, it's good news. We're getting pretty good return and the net asset value is not being sacrificed. Unlike, for example, funds, there have been many funds from YieldMax and others where the returns have been very high, the distributions have been very high, but net asset value has been going down precipitously. So let's talk about how long they've been doing it. They've been doing 25 weeks of distributions, and when you annualize it over a year, it gives a yield of around 26%. The monthly distributions do have a high variation. The range is almost 66, 67%. The average is around 25 cents per share per week. And again, if net asset value remains the same or increases, it is not destructive return of capital. And we'll talk about that in just a little bit. How do I expect XDTE to perform under differing market scenarios? I'm going to look at 4 different scenarios. One is just treading water, not much movement. So it should perform better than the underlying index because of the option premium. If it goes in negative territory, like it did last Friday, and like I was able to show you by showing you the trading details, it should perform frankly even better because you're getting option premium. The next option is, no pun intended, is if it increases but only slightly, right? In that case, it should match performance, because the best possible scenario is that in the example I gave you, they sold the call about 65 basis points above the price at the beginning of the day. And so if it's around that much of an increase, you are getting the increase in the underlying asset and you get to keep the option premium. So in 3 out of 4 scenarios, you actually come out ahead. In the 4th scenario, where you have very rapid moves in the index, you will underperform. And this is primarily the reason covered call ETFs will almost always underperform, because when you look over the long term, you will see that most gains in the market come over very few days, and they tend to be very high moves. And once you miss those moves, you miss them forever. So that's the reason why, even though in 3 out of 4 scenarios you're actually coming out ahead, in the long term you will slightly underperform the index in total return terms. Now, the fact that XDTE has not underperformed so far is good luck in my view. I don't think it's sustainable, but I'm certainly not cheering for it to underperform. but I do expect it to slightly underperform in the 100 to 150 basis points per year over the long term. So here's a summary and some key points about XDTE. One, note that it is owned synthetically. XDTE does not own either the S&P 500 via an ETF like IVV or VO, nor does it own it like iSpy does by owning the individual companies in the S&P 500 in the right proportion. So it's owned synthetically. It seems to work. The total return to date versus the underlying index is impressive. There's no other way to say it. I think the daily out of the money calls allow for participation even on positive return days, right? Unless the return is very, very high. And the overnight exposure to the index, by which I mean that there's no call sold overnight, is a tremendous positive and quite unique. Expense ratio is high. It's a tough weight to carry, right? So if you think about it, you got two people running and one guy has a heavier rucksack on the back. Even if he's a stronger or she is a stronger runner, in the long run you're going to weaken, and that's exactly how expense ratios work. In my view, covered call ETFs, a good expense ratio is in the 30 to 50, 55 basis points. Above that, it does seem egregious. Nonetheless, it has passed my criteria for portfolio inclusion. I'm holding my nose on the expense ratio. My expectations are higher income, lower volatility, slightly lower total return. So far, I've gotten higher income and lower volatility, and actually higher total return than the underlying index. So far, so good. Let's take a look at the quality considerations or evaluation criteria, if you wish, for evaluating covered call ETFs. There are about 11 things, 11 qualities, 11 aspects that I look at, and I'm going to see how XDTE performs against this 11 criteria. And there's a lot more to buying covered call ETFs than simply looking at the yield and expense ratio and perhaps total return information. There's more to it. So the first thing is, is the call being sold on the index itself versus on individual stocks? And that's a green because XDTE does do that. It uses the index. What's the notional value? That is, what percentage of the portfolio have the calls been sold on? So for example, if you can make your income targets by selling less than 100%, that's better, right? Because the portion that you have not sold calls on gets to appreciate further. In the case of XDTE, I marked it as in purple. As purple means neutral. It's, as best as I can make out, it's 100% of the assets have calls sold on them daily. Then what's the moneyness of the call? Are you selling out of the money or not? It is difficult for me to overstate the importance of this criteria. Do not buy ETFs that sell at the money calls. And in this case, they're clearly selling out of the money. And the example the real life example I followed was about 65 basis points, which I think is pretty darn good for about 7 to 8 hours of exposure. So I'm marking this as medium participation in gains. And one of the things when I researched was that 23% of trading days see gains greater than 1%. And the people who did the research looked at it over the last 10 years. So about 77% of the time, you're going to come out ahead, period. And then even on the 23% of the days when the gains are greater than 1%, you will at least be able to capture the first 50, 65 basis points of gains. Not bad, not bad at all. Next criteria is what's the duration of the call, right? So the shorter the duration, the better, because you're giving the market less time to move away from you. So this is day only, not even the full day, just the trading day. So this is green, green, green. I love it. Cash settled, You want the options to be cash settled. You do not want to be losing the asset and then having to purchase it. The transactions are much more expensive. In this case, green, because the options are on the index and they're clearly cash settled. Net asset value degradation, it's too early to tell. It's only 6 months worth of data, but it clearly passes the bar. And I'll walk you through my real life performance in a couple of slides. But the good news is good distributions and net asset value is holding. Total return, what can I say? I've already covered it a couple of times. They've beaten the S&P 500, a virtually impossible task. So green, green, green. Yield, when I bought it, I would have been more than happy with about a 15% yield. It's surpassed 25%. I'm obviously going to monitor sustainability, and I would only consider this real once I have perhaps 1 year's worth of data, and perhaps even more confidence after a full market cycle, let's say 5 years. Expense ratio, high, simply no two ways about it. Very worrisome, but I like the rest of the strategies, so I'm going to still stick with it. Tax efficiency, and by that I mean what percentage of the returns are non-destructive ROC. So far 100%, so I own it both in my taxable and tax deferred accounts. And then the soft stuff, that is, what is the reputation of the ETF provider? What is the quality of the people actually managing it? How complex is the structure? Because there are some ETFs that have advisors, sub-advisors, and sub-sub-advisors. So you can just imagine the complexity of interactions and so on. In this case, there's nothing negative. What I'll say is that Roundhill, in my view, and this is purely subjective, reasonable people can disagree, is certainly not a NEOS which simply, without any doubts or qualms, are experts at options, or nor are they Simplify, which is a ETF provider that I respect for their risk management capabilities. I own ETFs on both of those. So I don't think Roundhill is at that level, but these funds are certainly doing well. So I'm marking that as neutral. The sub-advisor they're using purely for white label regulatory needs, so I consider that a positive. That is, they're not doing something inefficiently. And then the small or low, relatively low assets under management of around 100 million is a little bit of a concern, but it's more than mitigated by the fact that it's growing at in the range of, by my calculation, 10 to 12 and a half, 15 million a month. And I'll start feeling much better once it gets to 500, 750, 900 million, and then ultimately a billion. And based on their performance, I see no reason why that could not happen. Okay. So where does XDTE fit into my portfolio? My portfolio has 6 tranches. There are 6 different strategies that I've identified that make up my portfolio tranches. The first is simply dividend growth, right? That is ETFs that contain companies with a history of dividend growth. Anything in green I own. The others are examples. So I own SCHD, it's my single largest position. And other well-known, rather reputable ETFs are, VIG, DGRW, Noble, so on. The next tranche is covered calls, and these are ETFs that sell out of the money calls on indexes, specialized indexes like Solactive, or are actively managed. And so there are 5 subgroupings within that. So GIAX is a relatively new ETF that actually uses worldwide indexes. They own developed markets, they own some unique countries, ETFs like India and Argentina. They own QQQ, they own the S&P 500, they own small cap value. So that's the base upon which covered calls are sold. So that's one strategy. Then ISPY, SPY, and XDTE, and this is where XDTE fits in, are based on the S&P 500. Then QDTE, IQQQ, JQ, and QQQI are based on the Nasdaq 100. FEPI is based on a very specialized index called the Solactive FANG Innovation Index, 15 companies equally weighted. JEPI and DEVO are actively managed. They use the S&P 500 as their base for selecting companies, but DEVO, for example, only owns about 30 to 35 companies. JEPI owns 100, so they're actively managed. In every case, the only thing common about all of these is that they're selling out of the money calls. The next tranche is a variation on covered calls where they're selling spreads, and the only ones that I'm aware of, and I happen to own them both, are SPY-T and QQQT. SPY-T is based on the S&P index, QQQT is based on the Nasdaq 100. Then there's a second variation. This is tranche 4, and this is where ETFs that sell out of the money calls, but on individual companies. And there's a company called Curve, K-U-R-V, that provides 6, and I own 5 of them. Goop is Google, AMZP is Amazon, NFLP is Netflix, AAPY is Apple, and MSFY is Microsoft. These are limited positions, no more than 1% max of my portfolio in these individual companies. Tranche 5 is a dividend futures based strategy and is my second favorite ETF after SCHD. It's called QDPL. I've done a video on it that you're more than welcome to look at. And then the last and sixth tranche is alternatives, away from equities and small positions and alternative strategies. SWAL is a mean reversion on volatility based ETF, and it's one that I'm extremely fond of. It has outperformed the S&P 500 consistently, yields about 15% plus. I'm capping that at about 2 to 2.5%. And then even though I'm dead set against stores of value like gold, etc., as assets, because I do not consider them assets, I was convinced by Lynn Alden that, and even Anthony Scaramucci, that holding Bitcoin does have some advantages. Amongst them are the fact that it's capped at about 21 million units. It can't just keep growing. And secondly, in most countries in the world where the financial systems are not as mature as, say, in the US or Europe, cross-border transactions, a lot of business transactions, people do them in Bitcoin because they do not trust their own institutions, and their own currencies depreciate rapidly. Like if you look at inflation in Turkey and Brazil and Argentina and many countries, you will see why owning Bitcoin would make a lot of sense for people doing business. So Maxi is a way to generate income from Bitcoin. I'm going to do a video on it later, and it does provide pretty good yield. So these are the 6 tranches of my portfolio, and XDTE falls in the second tranche, the plain old covered call strategy tranche. So what's my experience with XDTE? So before I get into the details, you got to understand where I am at and compare it to your position. I'm in the living off nest egg phase of my life. I'm retired and I'm relying on income from my investments to live on. So keep that in mind with everything else that subsequently follows. So my strategy at this stage is to generate income from equities and to not touch the principal if I can avoid it. Don't get me wrong. If I want to travel and I want to travel properly, and if I have to touch the principal, I will, but because I can't take it with me, but I would like not to touch the principal. I call my strategy enhanced income from equities. So XDTE is about 1.43% of my portfolio. It's targeted to be a minimum of 2.5%. I hold it in both my taxable and tax deferred accounts. In my taxable because of the return of capital classification of distributions. My position was initiated about 2 months after the ETF came out on May 17th, and I have been dollar cost averaging. I add to it regularly. I have a small capital loss, obviously unrealized because I'm not going to sell it, at about 2.93% as of last Friday. And the net asset value, in my view, is I consider that as holding. And income has hovered at around 26 percentage points, about 10 percentage points better than I had planned for when I initiated the position. I'm impressed with both their strategy and execution, and comfortable, meaning I don't sweat it, I don't toss and turn at night worrying about XDTE. I believe XDTE is a viable investment for both investing phases in the life of an investor. And I've recommended it to friends who are younger than me and in the accumulating wealth stage. I do not recommend this as part of their 401k or IRA, because if you're in your 30s and 40s and even early 50s, you really should be buying the S&P 500 index and the Nasdaq 100 in those kind of plans. But in your taxable account, to certain friends, I've said, build an income portfolio so that you can use the income for fun, like travel or gifts and charity and those kind of things. Couple of other things. QDTE is the Nasdaq 100 based version of XDTE. So XDTE is on S&P 500, QDTE is on Nasdaq 100. Gives an astonishing yield higher than XDTE. And then RDTE is a small cap version that is planned and will be available as best as I can make out on the 10th of September in 2024. So 1% of my portfolio is already in QDTE, and I keep adding, and I will keep adding until I'm at 2.5%. And I plan to purchase RDTE pretty much as soon as it comes out. That's how much confidence I have in Roundhill as it pertains to these three ETFs. So let's bring this baby home. Last slide. First, I wish you the very best of good luck in your investment journey. What I would encourage you to do is what my investing mentors, both in Seeking Alpha and other places, encouraged me to do. And I found it very helpful. One is document your strategy. And I'm not looking at a PowerPoint presentation of 35 pages. I'm looking at a paragraph that you have written to yourself and maybe share it with your partner or something like that. But a documented strategy is one that will make it easier to follow and will be more thorough. A good strategy is one that is simple, right? Simplicity always beats complexity. A great strategy is one that you will actually follow. So keep it simple, and if you're being true to yourself, you'll actually follow it. Never ever copy somebody else's strategy, because you will never have their commitment. You will only be committed to your strategy. That doesn't mean you can't model other people's ideas, but the strategy has to be unique to you and your needs. As Buffett and many others have said, when investing, remember that temperament is more important than intelligence. And by temperament, they mean having the stomach to ride out downturns, especially when it comes to equity markets. So if you can't stomach a 50% decline, a 40% decline, you should be very careful before getting into equities, because even though equities will give you higher returns over the long term, it'll be accompanied by ups and downs that you won't believe. So that's where temperament is very, very important. And then, unlike any other activity that you engage in, investing is about the only one where less activity is better than most activity. So try not to trade in and out. I tend to only buy, and that's pretty much it. I just don't like to sell. So when I make buying decisions, I'm thoughtful about it, take time, more time than perhaps I need to. But then once I'm bought, I don't sell unless something very fundamental has changed. Use tactics like dollar cost averaging. Don't try to sweat the details. Don't try to sweat perfection. Don't try to time the market and wait for some massive correction. If you have $2,000, invest it over 2 weeks, 4 weeks, 6 weeks, 8 weeks, 10 weeks. Doesn't matter what the time duration is, but do it on a regular basis until the last dollar is invested. So I only dollar cost average into positions, and I'm diversified, right? So you can see from my portfolio, I own multiple indexes, multiple strategies. Diversification is your insurance against making mistakes. Um, note, remember that investing, especially equity investing, is an optimist game. If you're a pessimist, uh, and there are some people who make a living, being pundits on the negative Nelly end of the spectrum, and they are the ones who hold gold for 40 years and so on and so forth. And it may look from my tone that I'm being negative or looking down on them or anything like that. Nothing could be further from the truth. But if you're an equity investor, you're betting on, in my case, America, its innovation, its energy, its ability to continue improving, its management competence, the ability to always be on the vanguard of the next new thing, whether it's AI today or something else tomorrow. So it's always you have to be an optimist to be an equity investor. So just keep that in mind. And remember, no free lunches. So understand the trade-off. What do I mean? If anybody tells you or you're looking for an investment that gives you higher return than the S&P 500 and higher income and lower volatility, ain't happening, right? You get to choose 2 out of the 3. So in my case, I understand the trade-off. Because I have prioritized income, I am going to have to accept slightly lower total return, period, end of discussion. So in your case, you must understand the trade-off that you are making. So again, in ending, good luck. Thank you for listening to this. Hopefully you learned about an interesting product, and my very best wishes in your journey forward. Bye-bye.